$33,000 in penalties, racked up by a Canadian landlord who never received the money. The obligation fell on her property manager. Her property manager didn't know the rule existed. Neither did she. This is Natalie. She's 58, a retired teacher from Victoria, British Columbia. When she retired, she began spending extended time with her daughter in Arizona. 6 months, then 7. After several years, she crossed into non-resident status for Canadian tax purposes. She kept her Victoria condo. She rented it to a young couple for $3,800 Canadian a month. She called her property manager, gave him the tenant's details, and told him to collect the rent and transfer it to her account. The rent was paid, the money flowed. Nobody touched the 25% that was supposed to go to the Canada Revenue Agency. Nobody knew it existed. Under Part 13 of the Income Tax Act, when rent is paid to a non-resident of Canada for Canadian property, the payer, the tenant or property manager, is legally required to withhold 25% of the gross rent and remit it to the CRA by the 15th of the following month. The obligation falls on the person paying the rent, not the person receiving it. Natalie wasn't the one breaking the rule. Her property manager was, without knowing it. At $3,800 a month over 10 rental months, the annual withholding obligation was $9,500 taken off the top before a single expense is deducted. Over 3 years, the unremitted amount reached $28,500. Penalties on late remittances run 10% of what should have been withheld, plus compound interest. Total exposure? Closing in on $33,000. There is a fix, and it changes the math completely. Form NR6. The NR6 is filed by the non-resident landlord or their Canadian agent, asking the CRA to allow withholding based on net rental income rather than gross rent. Natalie's gross rent was $38,000 a year. After mortgage interest, property taxes, management fees, insurance, and maintenance, her net rental income was closer to $14,000. With an approved NR6, the monthly withholding drops from $950 to roughly $175, a savings of more than $7,400 a year. The catch? The NR6 must be filed and approved by the CRA before the first rental payment of the year. File it late, and the gross withholding rule applies for the entire year. Once an NR6 is in place, a Section 216 election return must be filed by June 30th of the following year, a separate return from the regular T1 reporting net Canadian rental income at graduated rates. In many cases, a refund is possible. If gross withholding happened without an NR6, Section 216 can be filed retroactively up to 2 years after the tax year. Overpayments can be recovered. And if the landlord has been non-compliant entirely, the CRA's Voluntary Disclosures Program offers penalty relief, sometimes interest relief if you come forward before CRA contacts you. Once an audit letter arrives, the VDP window closes. If you own Canadian rental property and live outside Canada or are planning to, 3 things to know before the first rent check arrives. First, confirm your residency status. CRA's determination is based on where you live, where your closest ties are, how long you spend outside Canada. The threshold is the gate, triggering Part 13 on every rental payment that follows. Second, file Form NR6 before the first rental payment of the year. The CRA must approve it before net basis withholding can begin. File it early, processing takes time, and the benefit only applies from approval forward. Third, if you have been renting as a non-resident without Part 13 compliance, contact a Canadian tax professional about the Voluntary Disclosures Program before the CRA contacts you. VDP can eliminate penalties and reduce interest, but only while you remain unknown to them. Natalie's story has a reasonable ending. Her accountant filed a voluntary disclosure, secured penalty relief, and set up an NR6. Now she pays a fraction of what she owed. But she spent 3 years not knowing the rule existed. The rule applies the moment residency changes, whether the landlord knows it or not.